Snap Inc. is classified on the New York Stock Exchange as a camera company. However, we believe that this company more closely aligns with the inner workings of a technology or social media company due to the popularity of Snapchat. I believe that this classification is due in part to the fact that Snap wants to diversify their product line into something much more than this social media application. As to what exactly this company is going to expand into is still unknown. Over the past several years, we have seen Snapchat increase its daily users and yearly revenues. However, the company has reported negative earnings since it began in 2011. As a tech company, we know that they have been constantly reinvesting a large portion of those revenues back into the company, but at some point we have to see Snap start operating it into the green. The managing body of Snap claims that the reinvesting will slow down significantly and that the profits will start to come in. This past year, Snap issued its public offering and opened it to the public at $24 a share. After an initial spike in price, we see the current stock being traded at $22.21 per share. Over the next couple of years, we will see how Snap will manage its expenses and generate its revenue, whether it be through their largest stream of advertising or diversifying their product line into something completely different.
The current bull market experienced by the U.S. economy is the longest since that of the rally following the 1929 stock market crash. Currently, the total market cap to GDP ratio is recorded at 131.4%, the highest valuation since December of 2000. This can be seen as a very strong signal for the prospect of imminent correction. The current total market index is at 24.8 trillion. Utilizing historical evaluation data, the U.S. stock market is positioned to incur an average annualized return of 0.9%, including dividends, in the fiscal year 2017. Because of this, the investment research firm has deemed the current state of the market as significantly overvalued.
We believe Snap Inc. stock to be considerably overvalued relative to its peers in the industry. Taking into account the price to sales ratio for the trailing 12 months, we can better understand the current valuation of Snap in relation to similar unprofitable companies in the tech industry. Snap Inc.'s price to sales ratio is currently 60.65, 56.9 times above the technology sector's average. This suggests a premium valuation for the company. We expect Snap's share price to decrease 41.1% over the next year, evaluating the company through a utilization of a discounted cash flow model. By forecasting free cash flows through fiscal year 2020, discounting these cash flows by the industry average weighted average cost of capital, we came to an $8.66 billion valuation, which is significantly lower than the current market cap of the company. By dividing this valuation by the current number of shares outstanding, we arrive at $13.08 target price. Ultimately, we believe that there are significant risks associated with the purchase and holding of Snap Inc. and have given the security a sell rating. Any investor contemplating an equity investment in Snap Inc. should pay close attention to the company over the next year for indications of a positive earnings report.